financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome, and you are listening to the Financial Survival Network. I'm Kerry Lutz. It's October 24th, 2017. The year is rapidly ending. The end is coming very quickly, quicker than you ever thought possible, but you always know all years end the same way. So, person you're about to hear from tells you no matter how much you're making in real estate, well, maybe, but think twice before you give up your day job. And he's certainly somebody who can afford to give up his day job. I'm with Lane Kawaoka, and Lane, the number is 626. You should be playing that on Lotto. Welcome to the show.
Hey, Kerry, thanks for having me.
Hey, and before I forget, I'd be remiss if I didn't remind you, email us at kl@kerrylutz.com. The Twitter feed's at Kerry Lutz. So, Lane, you are basically a civil engineer, city project engineer. I mean, you've got a lot of time and money wrapped up in your investment, and yet you now own 626 units of multifamily housing. How did that happen?
It all started with buying that first single-family home and just kind of scaling up and meeting the right people along the way and getting to bigger deals.
Mm-hmm. So what was your first investment? How did it start?
Yeah, the number seems pretty large, but it first started as I was an accidental landlord. So I bought a primary residence and just started renting it out way back when in 2010, 11. And, just started, saw that there was cash flow there. The mortgage was well beyond the expenses, but then realized that, you can make a bunch of cash flow in the delta between that. And I just really got motivated about saving money and saving up for another down payment. I don't really do any of the no money down kind of stuff. I don't really do that. I was always an engineer and had a decent job and I could save money. So I just saved for another property, and then just things kind of just exponentially increased from there.
Yeah. Do you get financing from outsiders? Do you have a fund or anything like that, or are you just doing it all on your own?
Yeah, initially I just used the traditional Fannie Mae, Freddie Mac, just like the loans that we use, most everybody uses for their primary residence. You can get up to 10 of those in your name, where you put down the traditional 20% down payment. So a lot of those in the first initial homes were $100,000 that rented for over $1,000 a month. So, a lot of us investors, we use this terminology called the rent to value ratio, right, which is the monthly rent divided by the purchase price. If you're above 1%, that's a good starting point of, indicator that you're going to be cash flowing on the property. Because, I have a busy day job and I don't really have time to do the property management. So I hire that out, and, you're always making fixes here and there on the property. So you've got to have a pretty healthy cash flow in there, which all leads to that rent to value ratio when you're first picking up a property. But yeah, just keep scaling up from there. Once I got to 10 single family homes, then I looked into the multifamilies. But it all came back down to the getting started and getting that first few homes. Hey,
but now prices have been bid up so high, Lane. Isn't it hard to find those properties that are selling for more, that'll rent for more than 1% of their current value or purchase price?
Yeah, they're still out there. I mean, you couldn't find those kinds of places, and Seattle was where I started, so a very high price market. But anywhere on the West Coast or Hawaii or the East Coast, you couldn't find any of those properties even in 2012. A lot of the places, the more cash flow investors are going to are out of state, and they've just kind of gotten over the fact that they're going to be remote landlords or property owners. Places like Memphis, Kansas City, Birmingham, Atlanta, Indianapolis. These are like the blue-collar states. Median home prices are about $120,000 for a 3-bedroom. That's like 1,500 square feet. So it's kind of a paradigm shift for a lot of folks.
Yeah, understood. So prices, continue to go up. Do you think we're getting towards a peak in real estate prices and then we'll see a pullback of some sort?
That's what a lot of people say. I mean, it's been the longest recovery. I don't even know how long since. 2008 was a really, really long time ago. Usually, the books, they say, market cycles anywhere from 8 to 12 years. A lot of people are saying that in the next 3 years, there's like a 50% chance of being a correction. But that's why we buy real estate. It's a hard asset, and it's actually worth something at the end of the day, as opposed to the paper stocks or mutual funds and the 401k. That's the stuff that's going to get hammered the most. The real estate, it's cash flowing, or it should be cash flowing. So even if there's a correction, it should pay for itself. That's the way I see it.
Yeah, and you're kind of in like boring markets, dull markets that haven't seen tremendous appreciation like you've seen on the coasts since the crash, basically, of 2009.
Right. It doesn't have quite the frenzy that like a San Francisco or Los Angeles has. And that's kind of a good thing when there's a correction. These places, like my Birmingham properties, they don't really appreciate. They do great cash flow, and which also means in a correction that it's not going to take a huge hit too. I don't know if I'm willing to guess, but in our next correction, that your San Francisco home might go down 30%. But the Birmingham property is definitely going to go down less because it didn't go up as high.
Mm-hmm. Okay. So yeah, basically the go-go markets, you got huge land costs. And in the boring markets, the cash flow markets, you've got pretty much much lower land costs, correct?
Correct.
So what are some up-and-coming markets you think that are relatively overlooked and underinvested in?
I wish I knew. You always try and look for the emerging markets. Dallas, Texas, the whole state of Texas has been on fire. And that's a good example of an emerged market. Everybody moving from California over to Texas because of the good tax climate and pro-business. But some other ones are like, Atlanta, that's kind of poised to be getting a lot more tech employers there. It's on that second tier of major cities. You try and look in the secondary markets and which one's going to pop. The primary markets are all the places that, we all know about, the Los Angeles, the Seattles, the San Franciscos, Dallas has kind of moved into that space. These are the places that, there's a lot of unsophisticated money and wealth in these locations, and a lot of people are bidding those properties up. So you need to kind of look in that secondary market. So secondary market, there's no really definition for it, but it's in that population tier that just beyond the major cities and has a potential to increase. So, again, these are like Indianapolis as another one, or Kansas City. It's on that next tier, and it has some potential to be a great powerhouse for employers, because it all comes down to the jobs. Like, what are the jobs? What are the blue collar jobs coming in? Because that's what dictates if it's going to be an emerging market.
Right. So what about parts of Florida? Any potential there? Just happens to be my home state.
I personally, I don't know very, very much about Florida. I know a lot of investors go down to Jacksonville, but, it definitely, Orlando comes up a lot of times in a lot of the apartment investors I talk to. Not so much single family homes. I don't quite know the nuances there, but, Florida's just a long way from Hawaii, and quite honestly, it's a little bit too far of a flight for me. So if there's anywhere in the country that I don't really focus on, it's Florida's and the Carolinas. I know North Carolina is a great potential for emerging market because of all the manufacturing out there, with Boeing moving a lot of their operations out there. Mm-hmm. And that's another thing. But it's a lot more, when you get on the ground, it's a lot more street to street, and even tertiary market. A lot of people, they know the submarkets within, like, even a Jacksonville, and that's kind of what level you need to get on.
Right. Makes total sense. Hey, so somebody just starting out today, a millennial, a Gen Xer. What advice do you have for them?
I think you need to take a look at your financial picture first before you even get started. There's three components. There's time, there's money, and there's knowledge. So you need to figure out what you have and what you don't have and what your competitive advantage is. Starting out, I didn't have too much time because I worked a full-time job, and I still do. But I didn't know too much, and check the box. I listen to podcasts. Like I have a podcast at simplepassivecashflow.com that people can listen to get my story. But just keep reading books. Again, I don't really condone reading too many books because I think people use that as an excuse. Most of it's just taking action, buying that first property. And then that third component is, how much money do you have to play with? And I give free calls just to kind of point people along the way. And the first thing I ask is, well, how much money do you get to play with, right? Are you someone with, a lot of time on your hands and you're broke? Well, I can't really help you. And I can't really say that this buy and holding thing is for you because it's a labor intensive investing. And, this real estate investing, if you don't have any money, then you might have a money problem because I can't help you invest nothing.
Yeah, well, I know it's been done. We hear about the stories all the time, but it's a little bit disingenuous, isn't it?
Right. I think it's a big hoax out there. They try and hold on to people's dreams and tell them that with no money they can purchase this property. That's the flippers and the wholesalers. They try and get those guys that just find properties for the other investors, and That's kind of the pipe dream that's being sold out there.
Mm-hmm. And like you said, it's a pipe dream. Usually comes to naught, and so you got to have some money. Everybody can put together $20,000, $30,000 probably, right? Beg, borrow, and whatever you got to do from relatives, friends, etc. What would you tell people not to do as newbie real estate investors?
I can't advise someone who doesn't have the cash and going down the wholesaling route because I've never done it and I understand it, but that's just not my expertise. But I think one big mistake is going down the flipper route if if you have some cash, because that's just a job. And, if you do the math, after you factor in all those holding costs and the brain damage going through, it's a business. That's just not what you signed up for. A lot of guys who are working professionals, they make more at their hourly job than they would at that flip, even just managing a contractor. And I think people see all the shows and it's kind of cool. It is kind of neat, like seeing the finished product. But when you calculate out the hours spent and the return, it just doesn't make sense. And they just were better off going in on their own deal as a single family home or duplex or being a passive on a larger syndication.
Right. Understand that. So makes sense. And hey, what would you say is the biggest mistake you made since you started investing in real estate?
It's more of a personal finance thing, but I would go and pay down my mortgage and my properties like a good little boy, and that's kind of one of the worst things you can be doing. That mortgage, that debt is one of the most important assets in there. Look at the inflation that's going to be happening, and you're not going to be able to see it clearly, but inflation is how the government pays off the debt. They're not going to tax us. They're going to slowly take it away with devaluing the dollar. And by locking in 30-year loans now, you kind of hedge that.
Gotcha. Well, that makes a lot of sense. And so deleveraging in a leveraged world is a mistake generally.
That's correct. Yeah, that's correct. What you don't want to do is you want to be putting every single money in that you have into just saving up for down payments on more investments. Paying down debt and all this about holding on to a property forever. That works, but it's not optimized. What you want to be doing is keeping your money working hard for you. So the whole thing about buying a property and paying it down, take a look at the return on the equity, and that's always a percentage. And that's the name of the game. You're just trying to keep your money at getting the highest yield possible. When you first buy a property in that example, you're probably making 10 to 30% a year. But as you get more equity, the denominator of that equation gets larger. Therefore, your percentage of yield gets smaller. So at some point, you're going to be making single digits. And at that point, you might as well be buying a savings bond.
Right. Hey, so what kind of return do you shoot for?
So, I mean, the single family homes, I mean, you're typically getting anywhere from 20 to 30%. I mean, I know it sounds crazy, but with these investments, you're making money four ways. You know, you've got the cash flow, which is around a little less than 10%, but you've also got the mortgage pay down, you know, because you're paying down the mortgage or your tenant is for you, which is a nice thing. You're getting some tax benefits, the depreciation, which you can flow through on your W-2 expenses. And you're also getting the appreciation because, again, you've leveraged the assets. So if you're effectively leveraging 5-to-1 on a 20% loan to value loan and the property goes up, you know, $10 in value, or if the property, if you put 20% down for every dollar that you put in, it's kind of gone up, you know, you've made $5 on any dollar and an increase on the appreciation. So I have a video on that on my YouTube site, kind of whiteboards it, but that's kind of the big thing, like why you should be investing on your own and doing this by yourself. Because I mean, you compare 20 to 30% with what you're getting in the stock market, 8 to 10 or whatever it is these days. And it's not backed by any hard asset at the end of the day. And it can just go poof in a bad week in the stock market. I mean, that's why we're doing it. And that's kind of been my passion is, you know, the Wall Street roller coaster has just been kind of taking money away from the middle class America, just robbing people blind and taking people for a spin with all these fees. And I mean, just in this case, I mean, as a direct investor, you can make about 30% on your own. And, you know, how did we come to this 8%? You know, a lot of people must have their hand in the cookie jar.
Yeah, for sure. I mean, you know, I don't have to tell you what Wall Street is like. You know all about it. And it's a big wealth transfer scheme where your wealth gets transferred to them a lot of the time. I won't say always. I know a lot of people who've made fortunes on Wall Street. Let's face it. We all do, right? But when you get down to it, there's a lot less there than meets the eye.
All right. And then another thing, you know, like these projects, you know, you're buying good homes for middle class Americans that, you know, they have good jobs that's helping, like, you know, manufacturing, you know, the real jobs here in America, not like the white collar pushing paper guys. You're giving them good places to live, and it's a way of taking money from Wall Street and rediverting it to Main Street.
Yeah, and Main Street is where most of you out there live. So that's something you really I love the way you put it. But yeah, so who has your best interest at heart? That's really what it comes down to. And the answer is that you're better off sticking closer to Main Street than Wall Street. At least you have a chance, because Main Street generally, right, more honest than Wall Street and less self-serving, wouldn't you say?
Yeah. There's just a lot more layers in the Wall Street. You know, there's a lot more people getting paid. I mean, look at the big buildings that they have. I mean, someone's paying for that.
Like insurance companies, right? It's all
Right.
banks and insurance companies. I mean, that's
Right. But I get it. You know, I mean, if everybody invested in real estate, you know, we wouldn't have people working 20, 30 years. You know, I mean, I don't know what kind of economy we'd have at that
terrible.
point.
That would be awful. We'd have a bunch of people going to their mailboxes figuratively, because you know that mailbox money. I love the concept of it, though. I really do, Lane. Hey, Lane, so we want to find out more about you. We want to go and listen to your podcast. Instructions, please.
Yeah, just go to simplepassivecashflow.com and you know, sign up for the newsletter there to get access to a bunch of spreadsheets and other documents that I put together in a Google Drive for folks. But if you listen to podcasts, I'm on Google Play and iTunes, Simple Passive Cash Flow. But yeah, just shoot me an email if you're interested, Lane at simplepassivecashflow.com. Probably better just to listen to the first few podcasts just so we have a better conversation going initially. But yeah, always looking to get people, you know, help people get started. And I don't sell houses. I don't really do what other guys do. It's more of a, hey, let's go take down Wall Street in a more efficient way than pitchforks and torches and doing like a silly, you know, sit in the middle of a park kind of 99% thing.
Well, we never advocate violence or, you know, success is the best revenge, right?
Right.
Well, hey, if you got a question for Lane, you want to direct it to me, KL@kerrylutz.com. And make sure you check out the site, financialsurvivalnetwork.com. and the Twitter feeds at Kerry Lutz. The Facebook page is Financial Survival Network. Lane, it's really been enlightening speaking with you. I hope you'll come back again periodically. Keep us up to date. Definitely when you hit 750 and then when you hit 1,000 doors, we want to talk to you.
Yeah, maybe if guys have questions, we can just queue them up and I can come over and knock them out.
You got it. All right. Hey, Lane, thanks so much for coming on. Been a pleasure talking with you. We'll talk to you again real soon.
All right. Thanks, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network.